Good morning, everyone. On behalf of the Brazilian Central Bank and the International Cooperation Agency from Germany, GIZ, I would like to greet the participants and our speakers today. Yesterday, we had a connection problem from Switzerland. Mr. Luis Pereira da Silva, Vice Governor of BIS, but his lecture, his keynote presentation, will be transmitted tomorrow at the end of our event. So let's begin the second day of our webinar entitled Regulatory Initiatives Based on the Sustainability Dimension of AgendaBC hashtag. Today, we will have panel 2, Social, Environmental, and Climate Risks Relevance for an Integrated Risk Management Framework. The moderator of this panel will introduce the panelists and will explain the dynamic of this panel. He will also lead the Q&A session. So Mr. Guilherme Teixeira, Manager of Sustainable Finance from Citaui, Finanças do Bem, you have the floor.
First of all, I'd like to thank our speakers for joining us here. And I would like also to congratulate the Central Bank of Brazil for hosting this event. I consider that the theme of our panel here is at the core of the sustainability agenda recently announced by the Central Bank of Brazil. And now we have the opportunity to hear some insights from other financial authorities that have also been taking action to promote a better integration of environmental, social, and climate risks into prudential supervision. So as announced before, with us today, we have Mr. Patrick Ami from the European Central Bank. So Patrick is head of the Directorate General Specialized Institutions and Less Significant Institutions at the European Central Bank. He is in charge of the integration of climate-related risks into the ECB supervisory approach. Thank you, Patrick. We also have here Mr. Chris Fent from the Bank of England. Chris is a head of division responsible for developing and implementing the Bank of England's strategic approach to climate change. He's been particularly focused on the PRA's supervisory approach to addressing financial risks arising from climate change and for the development of climate stress tests. Just to clarify here to all our Brazilian audience, PRA is the UK Prudential Regulation Authority. So thank you, Mr. Chris. And we also have the pleasure of welcoming here Mr. Morgan Depré from the Banque de France. Morgan of Financial Regulation Policy and the Coordination Division at the Banque de France. He's also head of the Secretariat of NGFS, the Network for Greening the Financial System, one of the most important current initiatives to foster the integration of environmental and other climate-related risks into the financial system. So thank you also, Mr. Depré, for joining us here. So as everyone can imagine, based on the background of our guests here, there is no one better to discuss this theme than these speakers. But we also know that the integration of environmental, social, and climate risks in the risk management frameworks is one of the biggest challenges now for the financial systems worldwide, both for supervisory and regulatory authorities and for supervised and regulated entities. Thus, I have here two guiding questions which I hope will help us navigate these issues with our speakers who are wearing the same uniform. It seems to be the uniform of climate-related risks. So the questions that I have here are the following. So the first one is a broad question. So Patrick, Chris, Morgan, it will be very interesting to hear from you how your organizations are dealing with this topic So what actions are you taking now regarding environmental, social, and climate risks? And then I have a second question, which is more related to the supervised, the regulated entities. So it's mainly aimed at Patrick and Chris, but surely Morgan can say some words on that. So the question is, how can banks integrate environmental and social and climate related risks into their risk appetite statements, into their risk appetite frameworks, and the risk management processes like scenario analysis, capital adequacy assessment, stress tests? So it would be very nice to hear from you. So I'd like to invite here Patrick, Chris, and Morgan to make presentations that may help us answer these two questions. And in the meantime, I invite our audience to send any questions you have on YouTube, because after these initial presentations of our speakers here, we will move on to a Q&A round to further discuss all these topics. So please, Mr. Patrick, you are the first one. The floor is yours.
Okay, many thanks, Guillermo. Very delighted to be attending this panel. It's a very excellent initiative organized by the Central Bank of Brazil, and really delighted to be in together with Chris and Morgan. And I hope we have a very interesting presentation, discussion, and of course a lot of questions. I think it's always good to have questions. So let me start quickly with the ECB initiative, and maybe if we could, I don't know if we can upload maybe the presentation on screen. I hope this is possible. While this is done, let me start with just a few introductory remarks. I think in the ECB we started arguably a bit later than other supervisory authorities. I think we had a number of national authorities that started a bit earlier than us. In particular, the colleagues from the Dutch National Bank, from the Banque de France, from the Bank of England, I think were in many respects pioneers. Also the Bundesbank were pioneers in the early work on incorporating climate-related and environmental risks into risk management practices from banks, and into also the radar of supervisory authorities. And I think we have, of course, benefited from early moves from our colleagues, and tried also to incorporate all of this into our own thinking, and try to make sure that we have consistent practices across the board and in the European banking sector. And of course, we do this very much together with other authorities. For us, the environmental risks are basically have three main characteristics. They have far-reaching impact. I think this is not deniable. We have a lot of science behind that. They have an extended time horizon, and we know that it's very difficult, of course, to move away from the tyranny of the horizon, as you could call it, and to move away from the short-term perspective, or the medium-term perspective, and try and incorporate what could happen in the long term. And it's not only a question of happening in the long term, it's a question also of making sure that we act now, because the longer we wait before action, the more difficult it will become to mitigate the impact of global warming and also climate-related risks. So I think it means that we need to all together, supervisory authorities, regulatory authorities, banks, other financial institutions, we need to start moving in the same direction already today. And I suppose I will be joined with colleagues on this statement. what did we do? I think we first tried, together with colleagues, of course, to frame the impact of climate-related risk in the financial sector. And we know that traditionally we look at climate risks. Many thanks for uploading the presentation. We can maybe move to 2 slides down the presentation, if possible. 1 slide further, here it is. So we traditionally identify 2 main risk drivers: the physical risks, so the physical impact of climate change and the environmental degradation, and the transition risk, which is the cost of adjusting to a lower carbon and more circular economy. And those 2 main risk drivers have, of course, transmission channels via the corporate sector, households, public budgets, etc., and ultimately translate into the risks, the banking risks and activities in more traditional ways of looking at financial and prudential risk from a supervisory perspective, which are the credit risk, market risk, operational risk, liquidity risk, profitability, and so on. So this is very our sort of traditional view of the world, and we thought that the first thing to do would be to make sure that everyone understands that ultimately climate and environmental risk do translate into financial and prudential risk, and that they should be mitigated therefore via risk management, governance and risk appetite, and business model and strategy actions to make sure that banks and financial system in general can cope. So if we move to the next slide. Once we had, can we move to the next slide? Yeah, thank you. Once we had established a little bit our mapping of translation of climate-related risk into prudential risk, we had to establish our own roadmap, and we really started with a bit of a foundational and strategic thinking of how do we establish our own roadmaps to incorporate that new fact for us to some extent into our daily activities. And we started with trying to assess how SSM banks were currently addressing climate risks. It was a first phase, or really fact-finding on the European banking sector, then moving to developing and maintaining active dialogue and setting expectations to the European banking sector, and we are currently in this phase. And we will, going forward, update our supervisory practices by making sure that we incorporate our expectations and new risk developments into more decisive action in terms of setting capital requirements for banks, going into stress testing, and so on and so forth. And of course, we don't do this in isolation. We do this very, very much within a network of supervisory authorities and regulatory authorities, starting, of course, with the NGFS. And I think Morgan will certainly say a word a little bit about that in his own presentation. But I think it's for us extremely important to be part of the NGFS and to be able to share views, practices, ideas, strategies with our peers, with our colleagues, and to maintain sound and active dialogue with all stakeholders, being supervisory, regulatory authorities, or financial stakeholders, financial sector. I think the NGFS is a tremendous achievement for us, and we believe we really need to stick very, very much to NGFS development, and we are very active members within the NGFS. We maintain, of course, constant dialogue with key stakeholders, and we very, very much liaise with the European regulators, so the European Commission, of course, the Parliament, the Council, so the legislators, and also the European Banking Authority, which is the regulatory standard setter. The ECB, in this context, is a supervisor. So we apply regulations, and we work very, very closely with the EBA to make sure that we keep a very integrated and coordinated pace. And of course, we also work in the context of other institutions, in particular the Basel Committee, which has started also work in that context, as well as the Financial Stability Board. Let me move to the next slide. Just to give a sense of our initial stock taking of banks' practices, and it's just to give, on the basis of a limited sample, we took 24 important and internationally active European banks, and we benchmarked them a little bit with respect to a few basic questions with respect to incorporation of climate-related and environmental risk into risk identification and measurement processes, risk appetite framework, stress testing, ICAP, and so on and so forth. And you can see that the initial benchmarking showed quite a little bit of room for progress. And I think that was an eye-opener for us, and we thought it would be important to maintain dialogue with the banks. I think the fact that we started surveying the banks for their practices also started provoking movements in many institutions. I think it's fair to say that many institutions have already started before to look into the topic themselves, and so they are also very active, and I think we should not forget that banks themselves have started moving, and they don't necessarily wait, of course, for the supervisors, which is a very good thing. But as you can see, we saw that we had some progress to make. Let's move to the next slide. Okay. Just an overview of banks' practices. When we started benchmarking different practices, we looked at the bank's ICAP. So what is an ICAP? It's a little bit of a jargon in our practice. So just to explain, this is how banks themselves estimate and try to calculate what could be their own estimates of capital requirements to finance their activities. And what is, I think, really telling is that if you look at the right side of this chart, that we had basically a number of banks for which climate-related risks were either not considered or considered as non-material in the ICAP process of many institutions. And so, of course, it was another way to discover that we needed to see more progress in that respect. And also on the left end of the slide, when climate-related risks were incorporated, they were usually incorporated in the broader category of ESG risks, so environmental, social, governance risks, and not so much as individual risks per se. So they were a little bit diluted, and I think this is one of the lessons I would personally draw from this, is that once you want to really emphasize on climate-related and environmental risk, you need to depart from a pure perspective of ESG risks and move really more deeply into climate-related risk per se. So this leads us to also another, on the other slide, very quickly, I think, just to have a bit of optimism. Nevertheless, we could see, scanning a bit banks' financial statements and publications, we could see that banks were usually targeting strategies that were more or less in line with the Paris Agreement, so which was, of course, cause for optimism after seeing that we had quite some way to go. I think it was a bit reassuring to see that banks basically got it and already understand the direction of travel with respect to the Paris Agreement, which is, of course, very comforting. Let's move to the next slide. On that basis, we decided to issue supervisory expectations with respect to the incorporation of climate-related risks into risk management practices of banks. We published a draft guide on climate-related and environmental risks some months ago with a long comments period. We wanted to maximize the commenting period for the industry and for the different stakeholders. We've received quite a number of comments. We incorporated them. We have been considering all comments received, and we will soon publish the final version of the guide that will be applicable as of year end, we will also start looking more closely at the way banks do disclose information pertaining to climate and environmental related risks in their different financial disclosures. We believe this is a very important element of progress in the financial sector to increase disclosures and the readability of disclosures for different stakeholders with respect to climate-related risks incurred in the financial sector. Let's move to the next slide. So the guide covers essentially just one slide up, maybe? Yeah, just one up. Thank you. The guide covers essentially four key, no, one down, slide 9. The guide covers essentially four key expectations. Incorporation of climate-related risks into business model and strategies, into governance and risk appetite, into risk management, and into disclosures. And we have a set of more specific expectations for each of those key elements. So now if we move to the next slide, I will not go, of course, too much into detail for these different expectations, but basically we want to make sure that institutions understand the impact of climate-related and environmental risks on their business model and the environment in which they operate, not only in the short and medium term, but also in the long term, so that they are more able to make informed strategic and business decisions. And they should incorporate those risks that materially impact their business environment into the design and decision-making process for their business strategy. With respect to governance and risk appetite, we believe it is very important that the highest level of governance in the banks discusses, is aware, makes informed decision with respect to risks pertaining to climate-related and environmental risks. So this is really a call for making sure that climate risk does make it to the highest level of governance in banks, and that we have informed discussion in the management and supervisory bodies of the banks. That in turn should help the banks better incorporating these risks into their risk appetite framework. Also should help them to assign a clear responsibility for managing climate-related risks into their organizational structure and into their risk management reporting. Let's move to the next slide. With respect to risk management, so we have basically several sets of expectation, some expectations pertaining to the risk management framework itself, and how basically banks identify and quantify climate-related risks in their different operations, which of course should be particularly detailed in credit risk, operational risk, market risk, and liquidity risk, but also in scenario analysis and stress testing. And I think my two colleagues have more to say on that topic, so I will not dwell too much on this perspective, but it's a very important perspective, of course, to make sure that we all together develop proper capabilities for stress testing and scenario analysis as soon as possible. Let's move to the next slide. Thank you. So with respect to disclosures now, again, a very important aspect of our guide. We expect institutions to have policies, procedures, and disclosures as a minimum in line with the EU Commission guidelines on non-financial reporting, which are themselves based on the well-known TCFD set of disclosure expectations. And we really believe that this is an integral part of our expectations. This is the first time that the ECB issues expectations that are more related to the so-called Pillar 3 expectations in our prudential framework. The Pillar 3 expectations are expectations precisely related to disclosures in the prudential framework. And we believe it's very important that banks do make progress in that respect as well, by specifying considerations for the assessment of materiality of the risk. We have very often disclosures that simply state that climate risks are not material for the activities of the bank, but it's very difficult to understand how this determination is made for an external reader of the disclosures. And we believe it's important that we provide the market and every reader of disclosures and financial statements with the means to understand how banks themselves are making that determination. We want to see over time more qualitative and quantitative information, of course, underpinning the materiality assessment, more explanation of methodologies, definitions, criteria associated with metrics and targets. We have seen, which is a very good thing, by the way, that more and more banks are setting themselves specific targets with respect to climate risks. We believe it would even be better if those targets could be better defined, with methodology better explained, so that readers of those disclosures can fully understand what this means in practical terms. We also expect that financial institutions make sure that they disclose scope 1, 2, and 3 emissions for the whole group. You know that this is a very important and discussed element in the disclosures framework. It's arguably not always easy for banks to grasp very much in detail the full extent of its scope 3 emissions. I recall that the scope 3 emissions are the indirect emissions. So when you finance a customer that is itself more or less carbon intensive in its activities, a bank should be able to get that information to understand what is the extent of its scope 3 emissions. And it's obviously something where we all need to progress, where we have some data gaps from time to time, but it's important that banks start setting to it. We also hope to see them setting more key performance indicators, key risk indicators for their strategy setting and risk management, and to disclose those and how they are calculated, or again to facilitate the sound understanding of their disclosures by readers of disclosures and financial statements. Let's go to the next slide. And just to mention that in this guide, we really wanted to take a very holistic approach to climate-related and environmental risks, and make sure that banks do incorporate this very holistic approach in all their activities, business model and strategy, governance, risk appetite, risk management framework, reporting and disclosures. And we believe that if we all start in that way, we will make very swift progress towards better incorporation of climate-related risks into banks' activities, risk management, and therefore enhance and increase mitigation of these risks over time. Let me finish with this. What are the planned actions and follow-up? So this is the next slide. We plan in just a few days to issue the final version of this guide, and to enter as of next year into the supervisory dialogue with the banks. We will ask them to provide us with a self-assessment of where they stand with respect to the expectations that are set in the guide, and tell us how they see different areas for improvement for themselves before going into, in 2022, into in-depth supervisory assessment of banks' practices. This will go, of course, together with the work of the European Banking Authority with respect to integration of ESG risk into capital requirements. And of course, we are in the meantime working within the NGFS to make sure that we bridge wherever necessary the possible data gaps that we all know are out there for the time being, and we all know that we are sometimes missing data. And of course, in 2022, as part of our activities, we will also consider stress testing. Thank you very much.
Thank you, Patrick. It was nice to know about the ECB approach, the next steps, the challenge that you have faced. I also took some notes here regarding banks' practices. So the first one is about the internal capital adequacy assessment processes, so the ICAP. It becomes clear that it's necessary to review the ICAP. Also, the review of risk appetite frameworks are a good management approach, and it's necessary to take in the Paris Agreement into account. It's not easy, but well, let's have this in mind. And to conclude, it was interesting to see that the climate-related risks are not considered as a new category of risk, but as part of the traditional risk categories like liquidity risk, operational risk. So I would say that it's also interesting to have in mind. Now we can move on to Mr. Chris Fent from the Bank of England. Chris, more than 1 year ago, the PRA issued a supervisory statement also with some expectations for regulated entities regarding climate-related risks. But we know that you have been taking other steps also. So could you please tell us about this journey?
With pleasure. Well, first of all, thank you very much for inviting me here today in what is looks like a great event. And the timing of this event is obviously very important as well. That, you know, when there's so much else going on in the world, I think focusing on climate, which is not going away as an issue, is really important that we make the time for it. So thank you. And I'd echo I'd echo a lot of what Patrick says, but in particular how important it is that we work together on this, because this is quite a new area and we're all learning about how to do this. So the more that we can talk and the more that we can work in organizations like the NGFS and have more of these kind of sessions, I think the quicker we'll be able to move this agenda forward, which is of course important. Now, one point of clarification on the way that the Bank of England has looked at these risks is that there are a number of risks in the ESG bucket, and there's climate, there's environmental, there's biodiversity. We as an institution have focused on climate to date, and there's a number of reasons for that, but one of the main reasons is that we see this as the major risk that we need to deal with at the moment, and it's something that we need to develop approaches for now and start to take action now. That is not to diminish the other risks at all. They are very, very important. But I just wanted to flag that what I'm going to talk through today is very much focused on climate risks. There is work going on environmental and biodiversity, but I think it's fair to say that that is earlier in its inception compared to climate. Now, I'm not sure if we can show my slides, but if I just take a step back and talk about why we have focused on climate, I won't go over some of the points that Patrick set out, but and if you just go 2 slides ahead, what we looked at in 2015 was the insurance industry in the UK. And we identified that there was a linkage between climate change and the financial risks that were sitting on those insurance companies' balance sheets. And we did a similar review of banks in 2018 that just sought to reinforce how climate change could give rise to financial risks. And I think it's really important to say, just reiterate Patrick's point, that these are the same risks that we see in traditional frameworks. That climate is not a separate thing. The transmission channels that give rise to these risks go straight into a lot of risk in the system and a lot of risk in individual firms that was not being looked at. So we took that away and thought, what should we do about this? Now, usually for regulators and central banks, the next step would be to do a lot of analysis, figure out what the right approach is, figure out what best practices are, and then once you had all of that in place, you'd go out with an approach for what you expected the system and firms to do. This is different though, because it became apparent that we couldn't, in order for us to do that, it would have taken many, many years, because the understanding and the data needed to do that was quite frankly not in place. So we did something that's slightly unusual for us as a central bank, in that we went out with supervisory expectations for firms that they should be managing climate risks, but in the recognition that this was something that they and we didn't at that point have a very set idea on what best practice would be for how they should do that. So what we did was we put those supervisory expectations out in 2019. And if we go on to the next slide, the way that we framed those supervisory expectations was, it was actually sort of broadly, it was mirroring our supervisory approach, but it was also mirroring the approach to looking at climate risks that you see in the TCFD framework, in that there was 4 key buckets of expectations for firms. The first one was that in line with best practice and in line with firms needing to take a strategic view of these risks, we said that it was important that climate was embedded across governance discussions from the very bottom of the institution all the way up to the board. So every bank should be having discussions at every level, and they shouldn't just be adjuncts to other discussions that are having. It should be woven into those strategic discussions, and ideally they should be talking about risks, but also the opportunities. Now, in order to facilitate those discussions, we said that firms needed to embed climate across all of their risk processes, again, at every single level. So as Patrick said, what we want firms to get to is a point where climate is measured and then reflected in risk appetites and then the levels of risk that are exhibited in institutions can be considered, mitigated, and a strategic approach to managing them can be determined. Now that is particularly challenging because the traditional tools that we have for measuring risks, which is usually modeling and analysis of historic data, they're just not as relevant. The historic data is not as relevant for climate risks because they're relatively unprecedented. So the tools that we have do not really work for these types of risks. So firms have to develop new tools. And one of the key tools that we think there is to do this is the running of scenario analysis. And to say that I and others tend to use scenario analysis and stress testing interchangeably. I think strictly it's scenario analysis, but if you hear either, I think we're talking about the same thing. And what that is looking at a number of climate pathways over potentially some decades, and just thinking through the different paths of risks that could arise. Now, I'll come back to this in a bit when I talk about how the Bank of England is thinking about that for its own exercise. But what we've said is that all institutions should be developing scenario analysis as a key tool to understanding how risks arise across their organizations. And then they should be using that information to feed back into their risk appetite discussions and then into their governance discussions. Now, the final piece of this, and this is really, really important, is on disclosure. So I think you'll be aware that under the Basel frameworks, firms need to disclose their risks in their Pillar 3 disclosures. So they make those risks public, so they can be looked at, they can be challenged, and they can be compared. What we've said is that we need to get to a similar place on climate, and we need to have metrics and KPIs that allow us to do that in an intuitive way. Now, again, this is challenging for the same reasons that I said before. Climate risks are not measurable in the same ways as other risks, so it's not as straightforward as we'd like it to be. But we've said that firms need to develop capabilities to be able to do that, and the TCFD framework provides a really great starting point for how that can be done. So really what we've said was that firms should have this chain of events: governance, risk, using scenario analysis, and then disclosing with consistency across all of those four buckets. Now, I don't think that sounds straightforward, and it definitely isn't straightforward. And because of that, what we didn't do was set a deadline by which time we thought firms would have to have embedded this across their organizations. But what we did do was say that we would be working with them to understand how quickly this could be done. And I'll come back to timelines in a second. The other thing I just wanted to note, and this was slightly controversial when we did it, in that we said that our expectations were relevant for all of the firms that the PRA regulates, outside of the very, very, very tiniest credit unions. So firms with balance sheets of sometimes even sort of £50 million have to meet these expectations. And we got a lot of pushback from this, because we were told that it might not be proportionate for firms that don't have as many resources to look at these risks. But we decided to do this because our observation was that sometimes it's the smallest firms with the most concentrated geographies or most monoline business models that have the most concentrated climate risks. For example, if you have a small firm that is concentrated its retail business in an area that is going to be prone to flooding in the next 10 years, then it's appropriate for that firm to understand and seek to mitigate that risk. So what we've said is that it does bite on all firms, but we can be proportionate. So we wouldn't expect the smallest firm to have an all singing, all dancing model to measure these risks, but we would expect them to have a high level view, kind of a top down view of how risks could arise in their business and what they would be seeking to do as a consequence of that. And then just the final thing I'd say in terms of what's included in what we expect of firms is that we have a regime in the UK where we allocate responsibilities for delivering particular supervisory approaches to senior members in institutions. So that's in both banks and insurance companies. And we found that by doing that, you get a lot more traction in terms of delivery. What we did for climate was we made it one of these functions. So we said that it was very important that somebody owns this. And each firm was asked to provide the senior person that would have responsibility for delivering on our expectations. Effectively, they would be on the hook. And what we've tended to see was institutions have provided the chief executive officer, the chief financial officer, or the chief risk officer as the people that hold those responsibilities, which is reflective, I think, their seniority is reflective of the material risks that we're talking about. Now, if we just go on to the next slide, I wanted to flag what we're seeking to do to try and get traction in this area, because it's very well for us as a central bank to tell institutions to do something, but when it is an area like this where we need to get traction quickly, and there's inefficiencies in institutions all doing their own thing, I think we have a very, very important role, similar to the NGFS and other organizations, in bringing people together and seeking to draw out expertise, share expertise, and just making the process of delivery more smooth. So what we've done in the UK is we set up a group called the Climate Financial Risk Forum, which is the CFRF. And this is a group of 5 large banks, 5 large insurers, 5 asset managers, and the London Stock Exchange. And we've got them together with the purpose of them determining for industry how they can develop practices for industry that would allow the supervisory expectations be delivered. And the headline purpose here is for them to share their expertise, but also it's a way for us to put something down on paper, to get some guidance out there from industry, and to really help the smallest firms that need to think about this but don't have the resources to be able to invest in it themselves. So the CFRF has now been running for nearly a year and a half, and it's produced a number of documents that seek to provide advice on how you can embed climate into risk management in banks and insurers, how you can embed scenario analysis into banks and insurers, and also a look at disclosure and the kind of first steps firms should take when they're thinking about their own climate disclosures. And we've found that those tools have been very, very useful for those that are just starting along the journey of trying to think about how to embed these risks. We've also done a lot of outreach with firms beyond this, just to seek to understand how we can help to fill a gap as a central bank and join up with others to drive this forward. On the next slide, this updates on what we have done since the issuance of the supervisory statement. So in July of this year, we issued a letter which updated our expectations for firms. So as I said before, we previously did not put a deadline by which firms should embed their supervisory expectations. Having spoken to firms and having got a better understanding of where we think the challenges to embedding this are, we came to the conclusion that actually we thought that the firms could embed management of climate risks by the end of 2021. If they used judgment to fill gaps where they don't have data, and if there's some flexibility in thinking about how deeply embedded it would be across the organization. So on the back of that, we have now told firms that we expect them to have fully embedded our supervisory expectations by the end of next year. And what this really means is that they should have done as much work as they can possibly do with all the resources that are available to have embedded risks in their credit processes, their onboarding processes. They need to be thinking about risks in terms of their trading book, where they have a markets portfolio. And they need to have gone through all of the thought processes in terms of where risks arise, how they can be measured, and the governance around them. And we'll be working with firms over the next year to ensure that they deliver upon that. And I think one of the key expectations here as well is whenever we talk about this with firms, the key question that they have, and this is probably not surprising, is, you know, should we be holding capital against climate exposures? And if we should be holding capital against them, how should we be holding it? In what form? Is it Pillar 1 or is it Pillar 2? Which are different types of expectations for capital in banks and insurers. What we've said, we've slightly thrown this back to firms, and we've said, well, it's your responsibility to understand risks. Whilst there isn't a clear framework for linking climate risks to capital requirements, what we expect them to do by the end of next year is thought through that chain, thought through whether they think that they need to capitalize against risks, or whether they think the risks do not exist in the short-term period that capital would cover, or if they think the risks are already covered by capital. And they need to use judgments to do that. And I think this is one of the things that's been, that will be the most controversial with firms, because they will need to demonstrate to us why they don't think they need to hold capital if they're saying that they don't need to hold capital by the end of next year. And then just finally, one of the other things that we came out with in July was, having spoken to a very, very large number of firms, it was clear what some of them were doing that was really good, and it was clear that some of them were lagging behind, and there were some practices where it wasn't so good. So we provided some guidance, some feedback to firms on the best and the suboptimal practices that we'd seen from different institutions. We hope, as a package, what this will do, whilst being very, very challenging to firms, we hope that it will help drive the investment within firms that they need to have in order to move this agenda forwards. But we're under no illusion that the end of 2021 is quite a challenging deadline. And just on the next slide, this is just to emphasize what I've said, that we'll be working incredibly hard next year with firms to understand where the challenges are, and we'll have a couple of publications or workshops with firms updating on the lessons learned in this period. Now, one of the other things that we're doing next year within the Bank of England is we're seeking to put our money where our mouth is. We've told firms how important it is that they run scenario analysis to understand risks, and we think that it's no difference to us. As we don't have the tools to understand climate risk from a firm or a system-wide perspective, we think it is very important that we also run this exercise in order to get a better grip of these risks. And I think it's fair to say that running these exercises is incredibly challenging for the reasons I said before about the lack of data, but also when you're looking across the system, there's so many interactions that you need to measure. It is very, very complex to develop a framework for doing this, but it hasn't really been done before in any sort of bottom-up way. But what you're seeing across the globe at the moment is the bank has launched this exercise, the Banque de France has launched this exercise, and there's other versions of central bank climate scenario analysis that are being launched that is definitely one to watch over the next period. In terms of the bank's exercise, if you go 2 slides ahead, please, there's really 3 objectives that we're seeking to meet by running it. The first one is we want to get a better view of the size of climate exposures, both physical risks and transition risks, in the firms that we supervise, but also when you add it all up together across the UK financial system. The second one is that in the firms, when we look at how the risks could arise and where the concentrations of risks might be, we want to get a better understanding of the business model challenges that could arise on the back of that, and any particular vulnerabilities in business models that might be shown. And on the back of that, we want to really understand whether there should be a migration away from certain areas earlier than certain businesses might be seeking to do it at the moment. And then the third objective is really, it's important that firms do this. They are investing in this, but I think by us running this exercise, it just accelerates the investment that firms provide to these climate risks analysis. So we see it as a way of improving firms' risk management by going through this process and by us all going through it together in a concurrent way where we can share best practices. One thing that we do know from this exercise is that, because these haven't really been run before, we know that the exercise is not going to be perfect. We've developed a framework that we think can be used to stress climate, but some of it will work really well, I'm sure, and some of it will definitely not work really well. So this is a learning exercise for how these exercises can be done in the future. And just as an aside, some of the reasons why this is so challenging is that unlike when you're stress testing capital on a normal exercise where you do it over 4 or 5 years, say, and you can have a forecast that's relatively trustworthy, you can place some reliance upon it. Climate stress tests, they go out many, many decades, so you can't really forecast that easily out that long. So if you do forecast, then how do you control firms not assuming the problem away? And if you don't forecast, how do you manage a static balance sheet through that period? Conscious of time, I won't spend a huge amount of time on this one, but the next slide just talks about how we plan to do this with our framework. So within the parameters that I mentioned before, what we're going to do is we're going to launch our exercise in June of next year, and we're going to test firms against 3 key scenarios, which I'll touch on in a second. We're going to have a fixed balance sheet, and we're going to see how firms' current balance sheet is impacted by these 3 climate scenarios over 3 decades to 2050. And effectively what that's doing is saying is like how much of today's balance sheet would become vulnerable at different points in the period to 2050 under these different scenarios. In terms of participation, we're going to have the largest banks and insurers in the UK taking part. And we're going to ask them to do bottom-up analysis, looking at individual counterparties that they do business with, and seeking to understand how climate pathways can impact those individual counterparties for where they are material. So what we're asking them to do is actually incredibly challenging, because they'll need to have counterparty by counterparty level discussions. Just on the next slide, this is just setting out very briefly the scenarios that we intend to use. Sorry, just on the next, if you could go to the next slide, please. The background that I think is important to flag is I'm sure Morgan will mention this too. The NGFS is doing work on the creation of some key reference scenarios that we are using in our exercise, and the point of those reference scenarios is to provide some credible scenarios that can be used by anybody, banks, central banks, insurance companies, firms in the economy, to do their own scenario analysis. And by them using those scenarios, it reduces a barrier to entry to undertaking scenario analysis, because these are complex things to develop that require climate science. It also creates some consistency, because I think when we do stress test scenario analysis exercises, the extent to which you can compare results, I think, is very, very important. So you can actually get a feel for what one region or firm is telling you versus another. And over time, these scenarios will become more developed. So they're already on the NGFS's website, but a new version will be updated next year that has more granularity. And I really would suggest that anyone thinking about running scenario analysis over a number of decades for climate has a look at these scenarios, because I think they are a great launching point for doing it. And that's what we've done at the bank. So there's 3 scenarios that we'll be looking at. There's an orderly scenario, which is in essence a scenario that includes policy actions being taken by governments today in a relatively smooth way. And what that means is that you get some transition risks as economies change in the short term, but you reduce physical risks later on in the scenario. We, at the other end of the spectrum, we have a scenario where there is no policy action that's taken to mitigate climate risks. So in that scenario, you don't really have any transition risks, but you have huge physical risks down the track because the temperatures increase materially. And you've got something in between, which is a disorderly scenario, where you don't take any action, governments don't take any action for, say, 10 years. And then they take very quick action because of a Minsky moment, a big kind of climate awakening, which gives to quite acute transition risks. But also, but there are also high physical risks. And just to finish up on this slide, on the next slide, in terms of what we're actually going to do with this exercise, there's a couple of things. The first thing is we are not going to set capital on the back of this exercise. The analysis, it's too early on in its gestation. We don't think it would be appropriate to set capital on the back of this because the results will be too divergent across firms. But that's not to say that we wouldn't expect firms to use the findings from these exercises to inform their own views on where their own risks might lie and whether they think they should be holding capital. In individual firms, we'd like to identify where the business model vulnerabilities are, and then we'll have a discussion with them to understand how they're seeking to mitigate those vulnerabilities. As I said, we're going to add it all up to the system to understand where systemic vulnerabilities are, and then we could consider as an institution whether the central bank wants to take action on the back of those findings. We want to also understand where firms can and can't do this modelling. As I said, it's really ambitious. They might not be able to do everything that's asked of them. So we're going to seek to understand where gaps might lie. And also, I'm conscious that as a central banker and as a supervisor, I talk about risk the whole time. But actually, it's really important to talk about the opportunities. There are huge opportunities that come with the transition, and the firms that we supervise, but also the firms in the economy, can harness those opportunities to offset some of the risks. So we also want to understand what the opportunities are and how firms are thinking about those opportunities. I'm conscious that I've probably spoken for too long, so I will stop there. But hopefully that's given a quick summary of where we are in how we're thinking about climate risks.
Thanks, Chris. Thanks. Yes, definitely these exercises to better understand climate risks will also enable the financial institutions to capture some opportunities and create some opportunities. Well, I think that your comments on scenario analysis and the microprudential approach may be very useful for Brazilian authorities and financial institutions, mainly because TCFD recommendations will be part of Brazilian regulation within the next 2 years. So it will be very interesting. And you have also mentioned the importance of very small financial institutions. And it's also very interesting in the Brazilian context because the central bank here is responsible for supervising thousands of financial institutions from different profiles, size, locations. So it's a good point to explore, and we will have the chance to further explore it in our Q&A session. Now let's move on to Morgan. So Morgan, Chris started his presentation mentioning the transmission channels between climate change and the financial risks. And we have the opportunity to have here you as one of the authors of the Green Swan, the book launched by the BIS and the Banque de France. This book explains very clearly the relation between climate change and the risks to the financial stability. And so for those that have not read this book yet, I strongly recommend it. And so tell us, Morgan, how the Banque de France and also how the NGFS have been discussing and working on climate scenario analysis and other approaches to incorporate environmental, social, and climate risks. Please, the floor is yours.
Thank you, Guilherme, for your kind words. I hope everybody can hear me. Why don't we try to display the slides? And before that, before begin, I have to say there are two challenges for me this afternoon. The first one is to speak after Patrick and Chris. It's always difficult in any case. And second, I'm not a supervisor myself. I'm trying to live with that. It's difficult, but still. So I will focus specifically on the stress testing, the climate stress testing exercise that the French ACPR and Banque de France have been working on. And we can, of course, develop a little more and also include some considerations on the work of the NGFS. And also even, but maybe later on for the Q&A, we could also touch upon some developments of the Green Swan. So why don't we change slide, please? So let me begin first with the main objectives of this climate stress testing that the ACPR and Banque de France are working on right now. Well, of course, the objectives are manifold. Like many other supervisors, ECB and Bank of England, PRA, I mean, the Banque de France and ACPR have done a number of things before. In particular, they have carried out some survey and they've tried to assess the vulnerabilities of the French banking and insurance sectors by taking a look at the balance sheet at a given time. They took a snapshot. Which is, of course, a very good start, because you're asking your banks, okay, tell me what you have in your balance sheet, and according to a specific classification that you gave them, they will give you some ideas. The problem is, if you do that, it gives you a sort of backward-looking perspective on their exposures, because the balance sheet right now has been filled with a number of credit beforehand. And what you want to know is what is going to happen going forward. And you need to take this forward-looking approach, which is, of course, key to understand and mastering climate risk. And so the objective for the ACPR was to improve its understanding of the exposures of the French and the French banking and insurance sectors by adopting a forward-looking approach and not only a static approach. And also another objective was for the supervisor to make sure that banks and insurance were equipped, that they had the proper methodologies in-house to identify, mitigate, manage these risks. And I mean, also there is another objective that is not here in the slide, but you will see that the stress testing is built on a static balance sheet hypothesis to begin with, but then on dynamic balance sheet hypothesis a bit later on. And I mean, we wanted to combine the two because we also wanted to understand and capture better the strategic decisions financial firms would take to mitigate climate risk. So not only taking a snapshot and see how the exposures evolve, but also see how it evolves when they make their own decisions to kind of diversify away or arbitrate, when they do some arbitrage to modify the composition of their balance sheet. The industry, well, clearly the objective for them is to better understand the transmission channels. Also, very important point, this is a point they made to us, but also they made to the NGFS, on a regular basis. They want to have comparable scenarios and comparable set of assumptions, because otherwise it's difficult to determine exactly who is more exposed to what. And the idea was really to say, please work on a consistent set of assumptions, consistent set of scenarios, and not only ad hoc shocks or sensitivity shocks, so that we can really have a clear view on where we're standing compared to the others. And the last point was also, we wanted to include in that particular exercise the low carbon national strategy, which is a strategy defined at the level of the French government, whose objective is to meet the Paris Agreement by 2050. And there is a specific pathway. So this is also something we wanted to factor in this exercise. Next slide, please. So the time period starts from 2020 all the way to 2050. It covers both banks and insurance companies. And it covers the exposures of French banks and insurance companies in France, but also around the world. For example, if a French bank has some exposures in Brazil, then it will be captured in this exercise. So it's not only about taking a look at at continental France, but also a broader global perspective there. It does cover around 80–85% of exposures for banks and insurances. Another particularity of that exercise is that we wanted to make it decently granular in terms of sectoral approach, because of course you have two approaches possible, either bottom-up approach or top-down using a macro kind of scenario that you play. But we thought it was necessary to distinguish between various subsectors in order to have more clarity on the composition effect by sector. So we have identified 55 different sectors and subsectors. Those stress testing cover transition risks and physical risks, both. And as I said, it combines static balance sheet hypothesis between 2020 and 2025. And then after 25, we move to dynamic balance sheet assumption, simply because we want to take a look at the exposures between 2020 and 2025. But then going forward, we want to see how banks and insurance will evolve, react, change their portfolios, diversify the risk away. So this is also the kind of dynamic effect that we wanted to capture in the exercise. And of course, we do also some consistency checks and second round effects, of course, to make sure that the behaviors at the level of a particular bank, for example, diversifying the portfolio, is consistent with what is happening at the level of the financial sector as a whole and with the macroeconomic assumptions. Next slide, please. So here you have the famous scenarios. So as Chris mentioned earlier, the objective really was to rely on the NGFS reference scenarios. So as you may know, the NGFS published in June 3 reference scenarios plus a number of alternative scenarios, possible alternative scenarios, but all of them actually are built according to what Chris said. That is, you have an orderly transition scenarios, which is a pathway through which a country would adopt carbon taxing in time and following a pace that would allow a smooth transition progressively of its economy towards the objective of the Paris Agreement by 2050. This is what you see, the dotted green line on the screen here. So this is exactly the NGFS scenarios that we played. Second scenario that we are using is the delayed transition, variant 1. So here is a scenario by which there is no clear policy action for a little while, and then later on, as you see, as of 2030, there is a carbon pricing scheme that is in place, which triggers a transition that is, of course, a little bit more abrupt. than with the orderly transition. And it has some impact in terms as well of trade-off between physical and transition risks. And on top of it, we added a new ad hoc scenario that we call sudden transition. It's a variant 2, the red dotted line here. So again, we used the data that was produced by the NGFS, but we decided to make the delayed transition scenario a little bit more severe. So we anticipate a policy reaction that would be more abrupt, carbon pricing that would have a more severe effect, and some also effect on productivity that would be less positive or more negative, as you like it, than we have in the delayed transition. So it's a way for us to test a scenario that would be even less positive than the delayed transition scenarios. And also here put on the graph for information, we also have, it's not something that is in the NGFS reference scenarios, but we also have another scenario that is that there is simply no policy decisions, no carbon pricing at all. And so it's what Chris called the hothouse world scenario, whereas nothing happens, so no transition risk, but very, very severe physical risks. And we wanted to see what would happen for insurance companies only following that particular scenario, but not for banks. We're not testing this one for banks. So here, I'm not going to enter too much into the details, but this is the modeling architecture of the stress testing. I can say a few words about that. So at the top, you have the integrated assessment models, IM models, which cover several models that put together some climate variables and macroeconomic variables. And this is the model that is being used by the NGFS. And this IM brick models does produce some output in terms of GDP targets, carbon prices, and GHG emissions, but at a very high level and very macroeconomic approach. Then what we've been doing, we took the output of this IM models and we injected them in the NIGEM model that has been calibrated for according to the specificities of the French economy. And NIGEM gives you more macroeconomic variables. For example, inflation, employment, interest rates, other variables that you need to build your scenario in a way. And finally, the last macro step is the sectoral model. So as you will see, we have also used a mechanism by which we reflect according to 55 subsectors, the macro impact of a transition. And the three bricks that you see here, IM models, NIGEM model, sectoral model, is something that we've been doing ourselves. And we give that to the banks in insurance. And we ask them to play according to the variables that are generated by those three models. If you take a look at the graph here below, you see two additional bricks, a BDF rating model and financial modules. So here, what we wanted to do is to use those three bricks to check what the banks, to do a consistency check of what the banks and insurance companies were producing. And for that, you may know or you may not know, but Banque de France has its own proprietary credit rating models. And thanks to that, we have a number of info in terms of probability of default, for example, by sectors, by companies. And so we use that to be able to cross-check the outcome that banks and insurance will give us. It's a way for us to check. But of course, banks and insurance don't see that. It's a way for us to control that. And then we also have an in-house financial modules that helps giving us some financial info we need, for example, market valuation, etc., that are not being delivered by the IM models or NIGEM models. So all in all, this is the way things are being structured. Yeah, let's change slide, please. So here, what we wanted to illustrate, it is the percentage of deviation from the baseline scenario by sector over time. Just to illustrate, this allocation according to 55 subsectors. So you see, we have we distinguish three geographic areas. We have France, EU, USA, because some exposures are based in the USA, EU, France, and also rest of the world, but we don't see that here. And I mean, logically enough, the more you move towards 2050, the more negative and severe impact you see on some particular sectors. For example, petroleum is not doing good by 2050, whereas it's not necessarily the case at the beginning. But of course, I mean, we have something that is even more granular, but it's a bit more difficult to present those. But just to give you an example of how it works, and this is the impact we have following the disruptive sectoral shocks according to the sudden transition scenario. Of course, it's not easy, and we are really learning by doing. It is the first time we're doing this. We are working jointly, of course, with a number of colleagues with the NGFS, and we experience a number of challenges and difficulties. First of all, it is a problem that we're facing all. It's difficult to translate climate scenarios into economic and financial variables in general, and also to make them manageable by banks and insurance companies. So it is difficult. It is also difficult to put the two variables in the same box. And of course, we had to develop a suite of models to do that. There is no single washing machine kind of model that does everything for you. So you have to put together several bricks from several models, which is difficult. And for physical risks, so what we've done is a bit specific. We work with a French reinsurance company that's called the Caisse Centrale de Réassurance. And we have also worked with Aon based on one of the IPCC scenarios, RCP 8.5, to see what was happening. And we also include in there risk related to pandemic and health, which have to do with climate transition as well. So it's a very ugly scenario. And it's really an ad hoc specific kind of scenario that we have developed. It's not necessarily what has been done within the NGFS. Maybe last word I would like to say in terms of conclusion. Of course, climate change is a long-term structural process. That's true. There are some dynamic balance sheet effect that we would like to test to have a clue on the firm's strategies. Definitely 2050 is a tipping point, but the challenge is also beyond the structural effects. There are already some effects, some severe negative adverse effect that are showing now, and you need to measure it as well. So you need to find the proper trade-off between having a long-term, measuring the structural impact, but also taking a closer look at the more cyclical effect that's going to happen in the near future. There are also some benefits in there that's going to happen, and you need to capture them and to put them in a system as well. But you don't necessarily know how to allocate them throughout your transition pathways. And finally, just a few words on the process. So banks and insurance companies are playing those scenarios right now, and we expect to have a first round of result by December, so very soon this year, for a static balance sheet approach. And then there will be a second round in March 2021 where they will play the dynamic approach. And we hope that we will be able to publish the outcome, the aggregated outcome in April 2021. Something I should mention, of course, it is not really a prudential stress test in the sense that the outcome will not be more capital. It's not the objective of this exercise. It's pretty much about trying to experience something, trying to improve the knowledge, having a more dynamic approach, but we will not come up with a capital shortfall and a requirement for banks. Another thing I should say, it's voluntary. So banks are not obliged, banks and insurance companies are not obliged to do that. Of course, many of them do that, but they don't have to. So it's not exactly a stress testing exercise as you would think of it in an EBA or SSM or PRA kind of exercise. All right, just for you tonight, a nice reading list. Which covers everything I said, but in a much more detailed approach, scenario, the assumption, the modeling framework, guidance, scenario. So everything is in there. So for those who want to know more and open up a little bit the box and see what's in there, you have all the detailed descriptions in this reading list. Guilherme, I think I'm within time, and thank you for your attention.
Yeah, sure. Looking forward to seeing these outcomes in the next years. Thanks for sharing your experiences and at Banque de France, and I'm certain that the work streams of the NGFS will be crucial for the progress towards the suitable scenario analysis model. So thanks. And well, I think that it's clear that one of the biggest challenges here is to translate the climate change effects into economic and financial variables. And there is not a best way to do that. And it's clear that you are learning by doing, and it's a good signal not only for other financial authorities but also for financial institutions. And so let's make some space for the Q&A, and now we will have the chance to better explore all these issues by answering some questions from our audience. And I have a couple of questions to all of you here. So we can start with Patrick. Patrick, I have a specific question for you here. You have mentioned not only climate risks but also environmental risks, and you showed that these risks can be related to other risk categories, as I remarked after your presentation. And there is a specific question on it from our participants. So should social, environmental, and climate-related risks be treated only as drivers for other risks, or as standalone risks that may be transmitted for other risks? Could you please elaborate on it?
Yeah, many thanks, Guillermo. Yeah, it's a very good question and very, very complex one that is being heatedly debated in the supervisory and regulatory community. It's true that you can essentially address these risks as either a specific risk driver per se on its own that will be separate from credit, market, operational, etc., or as an additional impact on credit risk, market risk, and so on and so forth. And I think under the control of Chris and Morgan, I think we are basically navigating towards incorporating ESG risk and climate-related risk in particular as additional risk drivers that would have further influence on credit risk, market risk, etc. Because we believe essentially that it's an easier way to incorporate these kind of risk for banks, in that we have a more traditional and already established framework that is known to everyone, banks and supervisors alike and regulators. And we believe it is probably more helpful to start that way at least, and make sure that banks do incorporate, when they think about credit risk or market risk, that they do incorporate the climate-related aspect in it. There is a little bit of a risk, in my opinion, a very personal opinion, that if you stick to ESG risks as autonomous driving factor, you sort of leave it into a bit of a siloed world, in that you don't get enough interaction with the rest of the risk. And I think what we are seeing more and more these days is that climate risk is already having impact today on other risks like credit, or if you think of physical risks, for instance, and the materialization of extreme weather events, for instance, these are having a very direct impact on the credit risk of banks. So we believe it's probably, at the end of the day, a more understandable way of interpreting these risks by banks and regulators alike, and also probably a bit more efficient. But I think Chris and Morgan, don't hesitate to step in if you want to complement.
Yes, please, Chris, Morgan.
I agree with everything that Patrick just said. Particularly that this is quite a heated area for debate at the moment. Not really because people have materially different views on whether market risk, credit risk, and operational risk are the ways that you would measure climate risk, but actually how you get to that point. What are the forms of transmission channels, and how do you formulate the risk drivers going into those transmission channels? And there's lots of different ways of doing it that are very, very slightly different. But I don't think there's a huge amount of debate on the other side of the argument saying that you'd need something beyond credit, operational, and market risk.
Yes, Morgan, any additional comments on that?
Yeah, just to say that we certainly need to distinguish between the E, the S, and the G. I mean, within the NGFS, the choice has been made from the get-go to focus on climate risk for a number of reasons, in particular because it was probably the one of risk that was the most material in the shorter term, and also the easiest to capture with metrics. And it's probably a bit less easy for other kind of risk. We are working also within the NGFS on environmental risk at large, but it's less easy. The definitions are a bit more blurred, and metrics is not there. So I would certainly distinguish between the two. In my view, climate risk clearly is seen, it's getting more and more mainstream now as a source of financial risk, and you can capture it throughout many sub-risks like market risks, operational risks, etc., liquidity risks. For the other ESG risks, it's probably less so, and this is probably an area where further work could be done in the future.
Great. Yeah, and even we have here a couple of comments and questions regarding biodiversity laws and biodiversity risk. So there is a clear relation between them, and it may be hard to have a standalone approach to each of these risks. So I have also here some questions regarding data gaps. So some of you have mentioned that data gaps is one of the biggest challenges for performing scenario analysis to measure the risk, the exposure of credit portfolios. So I have a question here, firstly specific to Amanda at Chris. So Chris, you have mentioned the challenges of data gaps, and I have a question regarding building databases. So should environmental, social, and climate risks have specific databases to overcome these challenge of data gaps, or should be derived from other risks databases? What sort of data should be included in this kind of databases?
Oh, that's a big question. Let me kick off on that. So I think when we talk about data gaps, one of the key challenges is that the data doesn't exist. So it's not necessarily data availability in the terms that it sits somewhere else and you can't get your hands on it. It's just that these risks are unprecedented, so there's no prior. And if you think about it, if you think about physical risks, which is the changes in the environment around us, such as floods, hurricanes, that kind of thing, there's a little bit more data that you can get your hands on, because we've seen patterns in things like floods before. Forecasting allows us to look at how different changes might arise over time. So you can develop models that take us slightly further on that side. But some of the major changes with climate are from transition risks, which is, changes in government policy, changes in taxation, changes, disruptive changes such as technology, and that is just incredibly hard to predict. And whether things happen at a local or an international scale will impact the nature of how those risks crystallize. So I think we need to recognize that it's going to take some time for the models to be developed that allow that data to be, formed. In the short term, a way for us to get more data is to increase disclosure, not just across the financial firms that are regulated by central banks and supervisors, but also across the real economy, because it's really important to understand what's happening across the economy and not just in financial firms. Now, there are different layers of kind of data that you can get, and when you look at some of this, some of it goes down to kind of the zip code or postcode of particular exposures. There's a work stream that I was talking to the other day where they're using satellites to hone in on very, very small patches of ground to identify what exposures might be in those small patches. Really, what we're seeing is there's going to be a huge amount of data coming at us. There's a lot of analysis in this space, and the need for big data approaches, databases, will become incredibly important, because we're talking about something that's global, something that's worldwide, and is constantly changing. So it's huge. So absolutely, there is a need for extensive databases. I would argue, and I know this sounds slightly idealistic, but there's also a need to share as much of that data as possible. If all these databases exist over time and people don't share them, it's just going to slow down the process of us being able to measure these risks and facilitate a smooth transition. So I think the answer is yes, there's a place for databases. There's some data that exists that can be used already, and some of it is already available publicly. But over time, we should move much more in that space as more data becomes available.
Great. And Morgan, did you also face this kind of challenge for the stress tests at Banque de France? How did you deal with these challenges of data gaps?
Guilherme, can you hear me?
Yeah. Your voice seems to be far,
yeah?
but now you are back.
Okay. So I will let Patrick speak to the work we do within the NGFS, because Patrick is a co-chair of the data gaps work stream. So, but just one word on our domestic experience. I mean, what Chris was saying is right. In some cases, it's not only about finding finding data which exists somewhere, but you don't know where they are. It's pretty much about being in a situation where the data you need, well, simply don't exist. And to give you a very practical example, one of the obstacles we faced when we tried to measure the exposures of the French banking and insurance system was this classification of brown exposures. There is no brown taxonomy right now, so you have to find a way out to identify exposures. And when you ask banks, they will tell you that they don't have the possibility to give you exactly what you need, because they have their exposures to a specific sector, for example, energy sector, but they're not necessarily in a position to tell you precisely within that sector that amount is related to exposures to oil industry or to coal industry or to green industry. They're not able to do that. And it goes as well for other metrics. For example, the large exposures metric is based on it's a counterparty based kind of measurement, and it's also linked to the sector. But for example, you can tell the exposures of a given bank to Total or Petrobras, for example. But within that exposure, you won't be able to know exactly whether it is an exposure to windmills to solar farms or to oil gas fields. You just don't know. And for that reason, it is, of course, a gap, but it's not a gap that necessarily you can fill easily with actions from policymakers.
Thanks. And well, as Morgan said, Patrick, the NGFS has a work stream dedicated to bridge these data gaps, and you are one of the chairs. Could you please tell us about your impressions about this topic?
Thank you, Guillaume. Yeah, I'm afraid I have this dubious honor of being co-chair of this very important and difficult work stream, together with a colleague from the IMF, Fabio Metalucci. I very much agree with this distinction that we are making between data gap and data availability. I think it's not the same, undoubtedly. I just always tend to look at this distinction with a little bit of caution, because I think the risk, if we say data simply don't exist, is that we stop the work here and we stay idle until someone else will give us the data. And I think it is totally true that part of this data does not exist simply because there is no forward-looking database, and that a number of databases we have are by nature backward-looking. They are historical, and including in physical risk, for instance. You have historical data on floodings, for instance, and we all know that with the acceleration of global warming, we will, and we are already seeing acceleration of extreme weather events. So it is very likely that the backward-looking data you're getting already on floodings, for instance, cannot tell you exactly what will happen in future. So you have to resort to scenario analysis, and I think this is one of the things that Chris and Morgan discussed in their presentations, that we indeed need to resort to scenario analysis to look at what could happen and make sure that we get a better sense of this. I think we also need to think of what are the possible drivers of risks, and make sure that we understand where could these risks materialize, and what are the data points that we could think of for these risks to materialize. And if I just take a simple example, I'm pretty sure that many banks will tell me I have zero, for the time being, zero ability to gauge what is the carbon consumption of my mortgage portfolio. Each time I grant a mortgage loan, how can I know where is my carbon consumption altogether? We know that in some cases, in some geographies, you have energy efficiency classes. And I am pretty sure that for many banks, when they grant a mortgage, even if they don't gather that specific data yet, even if it's somewhere in a file, not centralized by the risk management unit at the bank, it is very likely that somewhere they have the information on each and every mortgage on the efficiency class. And maybe by starting to gather that data, they will be able to cover some of their data needs. So I think this is exactly what we need to think of as well, is to make sure that we make these data available, and we construct availability of data over time, either via disclosures, additional data gathering in-house, I think, and as Chris mentions, by also data sharing. I think it's an important element in the equation to make sure that people that have data do share data. So this is definitely a topic that is for which we have a lot of work to do, and we will of course continue in the coming months to work in this area.
Right, and I suppose that other government authorities, like governmental agencies, social agencies, research centers can be good allies to bridge these gaps. Am I right? Do you have any experience about this approach, this coordinated approach between the central bank and other authorities?
Yeah, I think you are totally right. I think the difficulty for us is that we are, with this type of risk, we are slightly out of our traditional comfort zone. We know how to go to credit risk. When you talk about physical risk, extreme weather events, you have to talk to people that know about the subject, that are scientists in climate, environment, and so on and so forth. So I think this is very important that we establish and maintain those contacts, and we get the science where it has to come from. And this is definitely what we are doing, basically. And this is very important that we get out of our traditional circle of contacts, of stakeholders, and reach out to the stakeholders that can effectively help us and provide us with additional information and data.
Great. And I also have here a question regarding scenario analysis, and to Chris. Actually, there are too many questions to Chris regarding your experience at the PRA and Bank of England. So Chris, does the Bank of England approach focus only on GHG emissions, or does it focus on other issues, for example, carbon sinks protection, which can impact directly climate risks?
That's a great question. So what we're looking at as the spine, as the skeleton for the scenario, is the carbon price, which is unique compared to the normal scenarios that we're set for our institutions. And by flexing the carbon price, we're able to generate some of the risks that fall out of the other scenario variables, which you'd recognize more as more familiar ones, such as GDP, unemployment eventually, that kind of thing. But there's a question when you're looking at setting a carbon price. What are the assumptions that underpin that? And how do you create a narrative to get to that carbon price? So at one level, you have the scenarios that we talked through in terms of the orderly, the late transition, or the no transition scenarios, and you can use that as a starting point for then thinking about what would have to happen from a governmental perspective in terms of official carbon prices or taxes or other mechanisms for setting carbon prices that would give rise to what you're seeing in that variable. But of course, the other point that's really important here is on technical innovation and the part that plays in determining what the carbon price is. And to be totally frank, this is really hard, because we don't want to be unrealistic about this and say there's going to be no innovation. Technology around energy is going to stay exactly the same, which means that any deviation away from traditional sort of coal or oil would need to be made up with wind and solar and technology that exists. Because frankly, we are seeing innovation, and we don't want to discourage that. But at the same time, what we don't want to be is complacent and place too much reliance upon innovation and basically assume the climate issue away. Because if we say that in 20 years' time, technological innovation will have created hyper-efficient wind energy and ways of storing carbon that don't currently exist, we'd hope that's true, but we can't guarantee it. So when you look at the scenarios that the NGFS have set, and then how institutions like ours are then taking it and wrapping it around our own exercise, you should see a variety of those assumptions being wrapped up into both the narrative and the variables that come out on the back of that. I hope that answers the question.
Yes, I think you have provided us a good answer. So unfortunately, I just realized here that we have only 10 minutes left, and we should conclude. So I'd like to invite you all to share some final considerations and, if possible, answer one last question. And so 6 years ago, the Central Bank of Brazil was one of the pioneers in the development of a comprehensive regulation for environmental and social topics. But currently, there are other new challenges to move forward, and the central bank has a multi-year plan on sustainability issues for the next years. Other financial authorities also will make progress on that. So if you could choose one specific lesson from your experience at the European Central Bank, at the Banque de France, at a Bank of England with the Brazilian authorities, what would it be? What could you say to Brazilian authorities as a suggestion, a tip, or well, any relevant comments to us? And please give us some final considerations. Up to you, Morgan, Patrick, Chris, you choose who will be the first one.
Well, let me try, Guillaume. First, I don't think anyone is in position to give lessons to anyone. So I think that's the first thing I would say. And I think, as you mentioned, I think Brazil, the central bank was at the forefront of developing also supervisory guidance for its financial sector way before other authorities, including the SSM. So I think I would certainly not provide advice, or I think I can just maybe say a few words about lessons learned from ourselves. And I think the first one is really I think to move away to some extent from the traditional ESG risk. And I think if we want to progress, we need to really deepen our understanding of the different components of the ESG risk, and in that case, we need to start with the E of ESG and climate part in particular. And I think it's absolutely critical that we really deepen our understanding on this, and that we move away from the traditional component, which is, I think, so far has been more sitting into disclosures than very often than risk management practices. And I think this is definitely one of the lessons learned for me.
Great, thank you, Patrick.
Yeah, I think my key observation is that this is an area where we need to make progress incredibly quickly. There's always a temptation to sacrifice making progress whilst we wait for perfection. And in this space, what that would mean is, waiting to have a clear idea of what perfect looks like, or waiting to get data through, or knowing what the framework should be. Whilst that is a temptation, I know at the bank, we're constantly having to push against that, because if we do that, it will be years and years until we actually get moving. And that's really hard for us institutionally as a central bank, because we like to have clarity before we come out with things. So my learning would be that it's okay to feel uncomfortable in this space and to push ahead in the absence of perfection.
Great. Morgan, could you please share your final thoughts?
Sure. I will refer to the Green Swan. In the Green Swan, there is this 5 C's rule. Central banks need to contribute, first C, to the coordination to combat climate change. And I mean, this is really key. Central banks cannot solve all the problems. There are many actors at stake here about, there need to be clarity on carbon pricing pathways. Also clarity on technologies. And at the end of the day, it's not the financial sector which will transition. It's the real economy which has to transition. And so the only thing we do, we need to be extremely modest, is to try to provide the tools, develop the right analytics to help doing this. But clearly we cannot do that in isolation. And it calls for close coordination with, of course, the governments, the fiscal authorities, the science, the academia, and not only with economists. This is another important point. I think Patrick refers to that earlier. To achieve something, we need to talk to climate scientists, physicists, a number of other people, which are not our regular customers, if I can say so. So yeah, need for coordinating action, need to agree to start working without having a perfect view of what is ahead of us, and agreeing also to be very humble and modest and learn by doing.
Great. Yeah, it's interesting to hear that because in general we hear that climate change is not only a task for environmentalists, but well, it's not only a task only for economists, but also for scientists, well, the fiscal specialists and other people. Well, it's nice to hear it, and it's clear that it's a journey of learning by doing. So congrats for your job and your journey, and I'm convinced that that all of your significant contributions here will be very useful to the Central Bank of Brazil, to our Brazilian financial institutions, and also to other specialists and people from other jurisdictions. Unfortunately, our time is over, and people in Brazil may be getting ready for lunch. So now I'd like to thank you again, Chris, Morgan, Patrick, and I'd like to hand things over to Davi, who will close our event today. Thank you.
Thank you.
Thank you to our moderator, Guilherme Teixeira, and the participants, Chris Faint, Patrick Amis, and Morgan Desprez, and also the participants of panel number 2 of our webinar. On behalf of the Brazilian Central Bank and the German Cooperation Agency, GIZ, I thank our panelists and our public. And I would like to inform you that the keynote speech from Mr. Luiz Pereira da Silva will be retransmitted tomorrow at the end of our event. Have a good day.